Let's shift focus and let's welcome on board Sumeet Nindrajog. He's the senior partner as well as co-founder at Paragon Partners. He joins in on the show right now. Sumeet, hi, good morning. Good to have you on the show. How is it that you're observing the impact of the pandemic on most companies? How has liquidity as well as cash flow across the board been, and have things really improved?
Good morning. Firstly, thank you for having me on the show, and hope you're doing well yourself. So just to answer your question, Paragon is a mid-market sector agnostic focused private equity fund, and our current investments are focused in the consumer space, financial services, manufacturing, and infrastructure services. I think, as you can imagine, the initial impact of the lockdown was quite severe. There was a fair amount of uncertainty with the extensions that came in as well. And so what we did at that point with our portfolio was really hunker down and focus on conserving cash, cost rationalization, working capital management, and then looking at pivoting business models where we could, and embracing digital and technology innovation as well. I think what we've seen subsequent to that, especially in the recent months, is a rebound in most of our companies. We've almost reached pre-COVID levels in several of them. While some are lagging behind a touch, we feel that they will rebound in the coming months ahead. We do remain cautious, though, because the pandemic has not exactly gone away. While the vaccine is around the corner, we do understand it will take a long time to administer across the country. So we'll watch it with caution, but do remain optimistic on the future. We're also pleased that some of the reforms that the government has announced, whether it be on labor reforms or with the PLI schemes, as well as the action that the RBI has taken, which frankly have really benefited the NBFC space, which was starved of capital for the past 2 years, given starting the ILNFS scenario.
Sure. Sumeet, your portfolio spans across sectors, from edtech, healthcare, IT, ITES, financial services, e-commerce, and the list goes on. If you had to give me some color on what part of your portfolio was the worst hit because of the pandemic, and where is it that you're seeing maximum signs of recovery actually coming in? If you could just diversify.
Sure. So I think just taking the first part of your question first, our consumer-facing offline retail portfolio was probably the hardest hit. As you can imagine, with malls being shut, offices being shut, particular investments that focus on fashion apparel, as well as food and beverage, were the hardest hit. But we are seeing strong signs of recovery there as well now. The automotive and aerospace investments business was also initially hard hit, which is many precision. But what they did very well during the pandemic is focus on diversifying their business development initiatives, which included into sectors such as industrials, healthcare, as well as consumer electronics, which I think will really bode well for their resilience in recovery going forward. Our construction services business, which is Capacite Infra projects, while suffered a lot initially during lockdown as construction was limited and there was a move of migrant labor away from the sites, I think the recovery from that has been very quick. They're back at all labor at site at 100% or above pre-COVID levels. They had entered the pandemic with a very robust order book of 15,000 plus crores, and with a large focus on government orders as well. And we feel very confident in the way they're going to recover in the coming quarters ahead. Our customized women's apparel business, which largely focuses in the US, really did some innovative things during the pandemic by focusing on launching customized masks, designing products which would focus on work from home for people in the US, and they made a very rapid recovery from the lockdown. Our NBFCs, obviously, there still remains some amount of uncertainty on where the credit costs will land up. But with the availability of the emergency credit lines from the RBI, have had ample liquidity and frankly are now approaching disbursals at pre-COVID levels. I think we remain cautious on where the credit costs will end up, but feel very confident on all of our companies to be resilient coming out of this lockdown.
Sure. Sumeet, is there any part of the portfolio or sector which continues to languish and you don't see signs of a material recovery coming in soon and thereby perhaps have to go back to the drawing board and relook into your investment?
I don't think any of our portfolio is languishing to that degree. As I mentioned, the offline consumer-facing retail recovery has been slower than the rest, but we're seeing signs of recovery, especially during the festive season. Frankly, even some of the offline businesses with an acceleration of online presence within their offering have hit close to pre-COVID levels already. We feel very confident that in the next quarter or so, we will fully recover across our portfolio, especially with some of the innovations that have been introduced by them. To give you an example, we have an investment in Chai Point, which is focused in the food and beverage space. They have exposure to offline retail stores, as well as dispensers at offices. The office business is probably lagging behind because a lot of offices are still work from home. But the innovations they've done by introducing contactless, dispensing of tea and coffee and contactless service at retail stores through mobile phones has really helped drive demand and recovery there as well. They also launched a direct-to-consumer offering on their own website to bring the chai experience to people's homes through packaged tea as well as ancillary food packaged products. And so, what we've really seen is by innovating, by cost rationalization, that our companies have been able to ride through the difficult times that we faced in the first 2 quarters of this financial year.
I was just thinking through it that a lot of flows of the PE world have suddenly moved into Reliance, whether it is the sovereign guys or whether it are pure PE guys like yours. Could there be a drought of fresh capital in the PE market given that Reliance, both at the retail end and at the Jio platform, already has attracted more than $10-12 billion?
I truly appreciate that. I think Reliance has done a magnificent job of raising money during this pandemic. But if you look at this, it's a lot of large global funds that have ample amount of dry powder still with them, and frankly have raised even more dry powder during the lockdown. The India-focused funds that traditionally operate in this space do still have a lot of dry powder. I think what you find is a lot of these private equity funds and venture capital funds spent the large part of the first quarter and a half on their existing portfolio like we did, ensuring that the business models were sound, that they had enough cash, enough runway, and the ability to rebound from these businesses. What we have seen is there's been no shortage of deal flow. If anything, we've seen an increase in the amount of deal flow over the last 2 quarters, especially in the mid-market spaces, as a number of companies that need to strengthen their balance sheets, as well as look at opportunities to accelerate their growth because of dynamic shifts within the market that would afford such opportunities are aplenty. I think we've seen a shift in our own focus from the second quarter onwards to deploying capital. Where, as I mentioned, we're in the midst of raising our second fund. We've done a recent first close, and we have a very robust deal pipeline of opportunities that are COVID resilient, that will take advantage of some of the schemes that have been introduced by the government in the mid to long term. And so we believe that deal investments will pick up in the coming quarter ahead. there's enough dry powder within the Indian ecosystem beyond what has gone into Reliance that will result in more investments in the coming quarters ahead. In fact, one of the things I would like to say is the opportunity, especially in the private market, in this vintage for private equity, could potentially result in tremendous returns going ahead. While the public markets have rebounded very rapidly in the last few months, you will see that a lot of that rebound has come from the larger companies with impeccable governance and strong balance sheets. The private markets are still languishing and need capital. And I think there'll be enough dry powder available and investments made in the coming quarters ahead.
Because of the COVID crisis, where do you think, or which end of your portfolio do you think has benefited significantly, and you're happy to even commit more capital to that company? I mean, since it's a private market, if you can, give an example, it would be lovely.
Sure. I mean, I think we're fully deployed from our Fund 1, which is 100% deployed. We limit our cross-fund investments. So maybe the way I talk about this is we'd be happy to support them with capital to the extent they need it. But at this point in time, a lot of them have sufficiently strong balance sheets and should be able to ride out, the storm. What may be more relevant to discuss is the areas of focus that we're seeing, and opportunities that we're seeing in the coming months from our Fund 2. We have a very robust pipeline of COVID-resilient businesses across sectors that include logistics, especially focused on the e-commerce space, edutech, healthcare, organized omni-channel fresh food retail, and tech-led financial services. Apart from this, I think with the recent PLI scheme, I think there are going to be big opportunities in some traditional sectors as well, like pharma, manufacturing, automotive, textile, food products as well. I think we're seeing a lot of great opportunities come across our table in these spaces as well. And we think that we will be deploying, dry powder into these opportunities in the coming quarters ahead.
Sumeet, hi, Avan joining in. Just wanted to understand, the flip side of this. At this point in time, what would you not look at? Is it because of valuations or perhaps because of the current environment, certain types of businesses or particular sectors that you potentially would avoid at this time due to the fallout of the pandemic?
Sure. I think as a fundamental principle, I think the first thing that we look for when we invest in a business is impeccable governance and very high quality entrepreneurs and management teams. That's something we will not compromise on. I think there are definitely sectors that are very hard hit, that are purely offline facing, and maybe more sort of real estate or office oriented at this point in time. I think the opportunities are aplenty in the sectors that I just mentioned. The private market, from a valuation perspective, has not kept pace with the public market valuations that you're seeing. And so from a valuation perspective, we still see reasonably attractive valuations across the sectors that I mentioned. I think we have to be very careful with financial services firms that are not well capitalized, that have exposure to a lot of SME businesses that have not had, that do not have the right sort of areas or focus or a lot of offline presence. And so we'll be cautious about that. But there are plenty of opportunities that present reasonably attractive valuations that we will look to investing in the coming months ahead. So I think it's not purely a valuation game, but to us, what's paramount is impeccable governance and very strong quality of management teams and entrepreneurs that we will look to get to invest in. And sorry, just to add, I think if we had to talk about sectors that will be challenged, they would be obviously hospitality focused, maybe restaurants and food and beverage, that will take a much longer time to recover. And so now is probably not the best time to be investing in some of those.
All right, Sumeet, thanks so much for taking time out and joining in, just giving us a perspective as to how things are shaping up on the PE deal front and, where you're sensing opportunity, what the pandemic fallout as well has been. Good to have you on board.